Hello, this is Kyler Worth of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we post our upcoming live show schedule on aai.com/webinars, and AAII members will have access to the full archive of shows. Our guests today are Roger Young, Matt Bykowski, and Charles Rotblatt. Today's show has 3 topics. First, we discuss how investors can utilize Roth IRAs to save money during their retirement. Next, we take a look at this month's First Cut mutual fund list. Finally, we break down the guidelines investors should use when selecting bonds and cash-like instruments. Let's get started. Today, I'm joined by Roger Young, Senior Retirement Insight Manager and Vice President of T. Rowe Price Advisory Services, Inc., to discuss Roth IRAs and the money you could save by converting. How are you doing today, Roger?
I'm good, thanks. How are you?
I'm doing great. Really excited to have you here. All right, let's
Happy to be here.
Questions. Thank you. When making the decision to convert to a Roth IRA, there are many factors that influence your decision, like your financial situation, your age, the state you live in, etc. Should investors also take into account external factors like a global pandemic when making this decision?
Well, events like a pandemic certainly affect financial markets, and so that does affect your decisions, including this one. If you think that your investments are well positioned for above average growth going forward, that would be, relatively speaking, a good time to execute a Roth conversion, if it makes sense in other ways. Now, sometimes you'll hear people talk about taking advantage of a dip to do a conversion. And I would rather you look at it in a more forward-looking way. So thinking about it in terms of the growth potential, because really you're saving money on the taxes that you won't pay on that growth going forward. So you also want to be sure that you're not trying too much to time the market. I think we all know it's very difficult to time the market. So rather than thinking of it that way, first I focus on the fundamentals of a Roth conversion, which are about taxes and estate planning, instead of your view on the markets. But all else being equal, there are better times, and a better time might be when you think that markets are poised for growth.
At retirement ages, the timetable for investors is a lot shorter when they were working. This isn't taking into account health problems or other concerns. Due to this short time span, retired investors may be wary of converting to Roth IRAs and paying those upfront taxes without the certainty that they will see the benefits that come from the conversion down the road. What would you say to investors to mitigate those fears?
Well, first, a Roth conversion doesn't make sense for everyone. And it's absolutely true that paying more taxes sooner only makes sense if you get enough tax benefits from the strategy over time. So I think of it as working best for people who don't expect to need all of their tax deferred money, assets like a traditional IRA or traditional 401k. They don't need all of that money for spending on their own in retirement. So if that's the case, then I'd encourage those investors to think about a Roth conversion and think about it in terms of the impact on their loved ones, especially in the event that they do die prematurely. So, for example, if you're married, Roth assets can really help your surviving spouse. The spouse will likely become a single filer, and therefore a spouse might jump into a higher tax bracket due to RMDs, required minimum distributions, that are more than they need to live off of. So the Roth can definitely help a surviving spouse. In addition, you might think about other beneficiaries. So if you have kids, for example, who are in a higher tax bracket than you, it can also make sense for you to pay the taxes up front on that Roth conversion in order to leave them the Roth assets. So again, it's not for everyone, but there are considerations beyond just your own longevity.
How can an individual investor predict whether a Roth conversion will be financially favorable for them to follow through with?
Now, there are a lot of factors to consider, as you mentioned earlier. This is an area where consulting with a financial professional can definitely help. And I know AAI members, like to do a lot of things on their own, but there are some times when, help from a professional really is advantageous. This could be one of those decisions. The decision should be part of a broader retirement income plan, and that should include Social Security claiming decisions. It should also include a tax-efficient withdrawal strategy. I spoke at the 2019 AAII conference about withdrawal strategies. And my white paper on that topic suggests a four-part test or way of thinking about it if you're considering Roth conversions. So those four parts are: one, you do expect to leave an estate. Second, you can comfortably afford the taxes on the Roth conversion because you pay the taxes at the time you convert. Third, you'll have unneeded RMDs, required minimum distributions, that will likely be taxed at a higher rate than the one that you'll pay upon conversion. And then the fourth item is about your beneficiaries, your heirs' tax rate, that it won't be significantly lower than yours. And if it's significantly higher, as I mentioned before, that would be a factor that would be in favor of doing the Roth conversion. So if all four of those things apply to you, then you go to the next level of doing some analysis and maybe talking with a financial advisor or a planner or a tax professional who can help you weigh the pros and cons.
You mentioned the importance of converting sooner rather than later, but can there be a situation where conversion happens too early? On the flip side, is it ever too late to make that conversion?
Well, first, I do want to clarify that a little bit. The main reason that you might want to start converting early is that over time, you'll be able to convert more assets without jumping into a higher tax bracket in any of those years. There's that constraint on how much you want to convert in a given year. And you want to be careful about things like tripping higher Medicare premiums, which can be painful if you go $1 over a threshold. But that all depends on your personal situation. It may not make sense to convert as soon as you possibly can. If you're in your career still and you're at a relatively high tax rate, for example. On the flip side, Roth conversions tend to make the most sense for people early in retirement before they hit the minimum required distributions, RMDs. That's a time when your taxable income might be lower than other stages of your life. So you might have room in a relatively low tax bracket to do the conversions and pay extra taxes, but again, not go into a higher bracket. After your RMDs start, you lose a lot of flexibility. So there could be situations where conversions still make sense after RMDs, but for a lot of people, they're more concerned about reducing their current year taxes than they are taxes down the road, because the RMDs, again, if you're thinking about a Roth conversion, those RMDs might be more than you need to begin with. So one conversion where Roth conversions could make sense in later years is if your beneficiaries are in a much higher tax bracket. So I would say it's not necessarily ever too late. It depends on your situation. For some people it can be too late once you hit RMDs, but for some people it might not be.
Well, thank you so much for joining us today. It's been a pleasure having you.
Thanks so much.
If you're interested in reading Roger's article, Can a Roth IRA Conversion Save You Money? Or others like it, you can find them in the September journal at aii.com. Once again, thank you and have a great day. Today, I'm joined by Matt Bykowski to discuss this month's first cut list for mutual funds. How are you doing today, Matt?
I'm doing good, Kyler. How are you doing?
Great. Happy to have you here.
Happy to be here.
That's great. Let's jump right into this. In the article, you mentioned that mutual funds are viewed as long-term investments. Could you explain why investors do not look at mutual funds to be short-term investments?
Particularly in this case, you want to think about investing for the long term, say 5 to 8 years, because we're dealing with equity funds. This first cut list is really looking at a way of investing in stocks, which historically have good long-term returns. In the short term, there's no guarantee that these returns will be recognized. especially when you consider short-term economic and market cycles. Small cap stocks are reliant on these cycles for their returns, even more so than large cap stocks. And historically, they even actually have higher returns than large caps. A long-term investment has captured more of these rotations through bear and bull markets, which when we look at the one-year performance for small caps on the first cut list, we can see this phenomenon. The recent bull market ended a long period of underperformance for small caps. Key to a solid stock strategy for an individual investor relies on patience. Part of the sacrifice for good long-term returns is liquidity and access to your capital. Institutional investors have to keep pace with the market quarter to quarter. Individual investors can stomach short-term trends for long-term gains, of course, assuming that you take advantage of a real portfolio strategy that involves diversification and looks past emotions. All that above is just about the stock aspect of long-term investing in mutual funds. Thinking about mutual funds specifically as long-term investments, 5 years of performance indicates how well a fund is being managed, which again, you should look at its performance and its management relative to its category peers. If a manager has good luck for a year or two, 5 years is long enough to kind of see that luck diluted out of its performance. Of course, past performance is not future performance, but consistency over a long period of time is a good indication.
Since mutual funds are viewed as long-term investments, it is expected for them to have little fluctuation or major changes. That being said, how often do the mutual funds in AI's first cut list change?
Yeah, so here we're talking about portfolio turnover, which is individual for each fund and has to be compared, again, peer to peer. Turnover ultimately comes down to the fund management and the manager's style or strategy. How aggressive are they being? Typically, higher turnover is associated with higher expenses. If a fund is regularly selling assets for a profit, the taxes on the capital gains will be passed on to the investors, which will cut into your return. Specifically, this is going to be an important difference when comparing funds to their peers. And then as far as turnover and strategy, some strategies require a lower turnover to be effective. Thinking again about the patience I talked about with returns for small caps, this also applies to value versus growth strategies. Growth stocks tend to be more liquid than value stocks, and lots of turnover in less liquid markets can be costly. Some funds will even close to new investors to keep their scale in line with their strategy. Overall, you probably want a fund with lower turnover than its category peers.
In the article, you mentioned the importance of mitigating risk, so it is worth paying attention to how some of these mutual funds grades trend. For example, the mutual fund Fidelity Small Cap Enhanced Index had a year 1 grade of B, year 3 grade of B, and a year 5 grade of C. Should this mutual fund be considered riskier than a fund with a grade trending upward?
Yeah, this is a great question because it highlights how to look at risk. In the first cut, we've eliminated funds with a category risk index grade of F. In the table, you can see each fund's category risk, which is the standard deviation or volatility of a fund's return over the last 3 years compared to the standard deviation of return for the average fund in the fund's category. So what that means is a category risk value above 1 indicates a riskier than average fund. And then also the inverse. So a value below 1 indicates a less risky fund compared to the average in its category. So as a quick example, a fund with a risk index of 1.3 indicates that it's 30% more volatile than the typical fund in its category. And, therefore you should receive a higher return for taking on that higher level of risk. Conversely though, that means that fund is also going to be subject to lower dips when the market is dropping or is volatile. Looking at the Fidelity Small Cap Enhanced Fund, its index, its category risk is 1.0. So that means it's right in line with its peers. No more or less risky. Looking at its trend in performance, in its performance grades, when you start to break out risk and returns year to year, as we're looking at the grades of B for 1 year, B for 3 year, and C for 5 year, what you want to see over the long term, as I mentioned before, is consistency, and especially consistency to the performance of peers. Where you really lose out with a mutual fund investment is when the fund is consistently performing worse than its peers. A good mutual fund is being managed to do as well, if not better, than its peers. The Fidelity Fund here is still above its category average over 5 years, even though its grades put it at the bottom of the small cap blend first cut list in this case. Again, the first cut list eliminates the worst performers, which are the funds you want to avoid. All the funds on this list are doing pretty well relative to their category.
The first cut list was broken up into 3 categories: small blend, small growth, and small value. Why would an investor pick one category over another? Or should they be looking at specific funds in those categories rather than the categories themselves?
Yeah, for this first cut, originally we wanted to look at just one category. We were going to do small cap value, but there were just too few small cap funds in general that met our passing criteria. As I just mentioned, we eliminate the worst performing funds from this list. So we screen out funds by expense ratio, risk, return relative to peers, and loads. Ultimately, this is why we included all 3 investment philosophies or strategies here: blend, growth, and value. For yourself as an investor, this is your choice to make, whether you want to look at blend, growth, or value. When you're deciding on a fund, you should look at the specific fund category. You should not just say, look at all small cap funds. You want to compare a blend fund to a blend fund, and a growth fund to a growth fund, and a value fund to a value fund, no matter if it's small, mid, or large cap. Because these strategies have different performance based on their objective. Again, looking at the 1 year returns between all 3 strategies, you get a really good indication of this. Value stocks or value funds greatly benefited from the recent bull market, as you would expect them to do. And this is especially compared to growth stocks, which before the pandemic were outpacing value stocks. So ultimately, it's really your investment philosophy that will guide you toward a category, blend, growth, or value. And then from there, you want to compare funds within that category.
Well, thank you so much for joining us today.
Thanks, Kyler.
If you're interested in reading Matt's article, Small Cap Funds Showing Strong and Consistent Relative Performance, or others like it, you can find them in the September Journal at aii.com. Once again, thank you so much for being here. Hello, I am joined by Charles Roth, Vice President and Financial Analyst at AAII, to discuss the strategy investors should take when selecting bonds. Hope you're doing well, Charles. Let's get right into this. What are the benefits in purchasing bonds that an investor would not get when investing in ETFs or mutual funds?
The big advantage of buying individual bonds versus buying a bond mutual fund or a bond ETF is control. As an individual investor, if you buy your own bonds, you get to decide your credit quality, what issuers you're buying from, the maturity, the tax exposure, and also which issuers you're buying from. So there might be an advantage, for instance, for you to actually buy from your local state government because there's certain tax advantages to doing so. When you buy a bond fund or a bond ETF, you're basically buying the equivalent of a suit off the rack. It's designed to fit one size fits all, but unlike that suit, you can't tailor it towards your needs. When you buy individual bonds, you get to have that customization. And where it really comes in is really for two aspects. One, if you want to build a bond ladder, then you can customize the bond ladder relative towards your needs, towards your income needs, in terms of when you need the cash flow, but also your preferences in terms of tax exposure and how frequently you want this bond ladder to be rebalanced, meaning as shorter term maturities mature, you either take that money and reinvest it back into a longer dated bond, or perhaps you take the money out for your spending needs. So you do get some customization advantages to buying individual bonds. The risk, of course, is that if you have a smaller portfolio, it can be harder to do, and your choice of bonds to actually buy will be more limited since you tend to have a smaller portfolio than the large institutional investors have.
You mentioned that bond ladders are a great way for investors to capitalize on different bond maturities and is a major advantage in purchasing individual bonds. However, what are the risks that come with investing heavily into individual bonds?
So when you buy individual bonds, or you buy bond mutual funds or bond ETFs, it's important to realize that bonds have limited upside. When you buy a bond, your income until maturity, or if the bond's callable, meaning the bond can be called back before maturity, you have a fixed rate of income you know you're going to receive. And as far as your price appreciation, that's going to be limited because bond prices can only rise so far. Interest rates, for instance, really can't fall below zero. Yes, we saw some interest rates fall below zero in Europe in terms of yields, but by and large, there's a floor to how far yields can fall. On the other hand, if a bond issuer defaults, meaning it stops making its coupon payments as agreed upon, then the potential for your bond is to lose all of its value. So bonds are a loan of $1,000 per bond in the US. Your potential is to lose all that $1,000 worth of face value. In a lot of situations, some of that money is recoverable, but you do have this downside that is down to zero. So those are your risks. But what you do gain, however, is that control. So when you're setting up a bond ladder, you do have the control about the income stream. You do have that control over the timing of it. But you have to realize when you're buying a bond, you also incur this risk of not only the bond itself, the bond issuer defaulting, but you also are locking in that stream of income. And while it gives you the advantage of knowing what you're going to get in, it's also not going to grow. So relative to the rate of inflation, you're actually potentially losing purchasing power because as inflation rises each year, your coupon payments are fixed. So your coupon payments are not going to rise with the rate of inflation unless you turn around and reinvest those coupons at higher yields. So you do have those downsides when you're investing in bonds.
In what situations would it be beneficial to an individual investor to make cash-like investments? And why would an investor ever need to limit themselves to a small number of institutions to hold their cash?
I'm of the opinion that cash plays a very important role in an investor's portfolio. There is this perception that cash is trash, particularly during low interest rates, because you're not getting much return on your cash investments or your cash-like investments, which can include money market funds, CDs, very short-term treasury bills. But what cash investments are designed to do is provide you with high levels of liquidity. So say you need to make a withdrawal in a hurry. Something happens to your roof. You need a big car repair. That cash allocation is designed to provide you that quick withdrawal. For retirees, when they're looking at required minimum withdrawals, having that cash allocation provides a safe bucket. So if they're required to make withdrawals from their portfolio during a down year for stocks, and maybe perhaps bonds are also down that year, you can then pull from that cash bucket without having to sell securities at a loss. And the key things about cash is it's a safe asset. It does not lose value when the financial markets are down. So that's the big role that cash plays. Yes, you're not getting any return from it. Yes, over time, you're losing purchasing power because it's not growing at a rate faster than inflation, but it protects the rest of your portfolio so you do not have to sell assets at a time there's a loss. If you know there's short-term spending coming up, having that cash set aside means you're not going to be exposed to the fluctuations in the market. So if you need X dollars at a specific date, say in 1 to 3 or 4 years, you know you have those X dollars set aside. And so should the market take an ill-timed downturn, you'll still have that money available to fund those purchases. And that's why cash can play a huge role in a portfolio. The key is to make sure that you're only allocating enough to cover that short-term spending and not so much that you're losing the growth aspect of your portfolio, because over time, cash will cost you purchasing power. $1 today buys far more than $1 will 5 or 10 years from now, because you do lose that purchasing power, your ability to buy goods and services with the dollars you have at hand.
Investing in bonds is a multi-step process that gives the investor an opportunity to choose what risk they are willing to take at each step: maturity, credit, and bond type. Most investors are likely going to incorporate a mixture of risk and safety that best suits their investing strategies. What would you say to an investor who wants to go all in on the risk? And what would you say to an investor who only wants to play it safe?
I think it's key to realize what the role bonds are. There's an old saying that bonds give you the confidence to buy stocks. Bonds give you the braveness to buy individual stocks. What bonds do in an overall portfolio is dampen volatility. Bonds tend to fluctuate less than stocks. And so that's the key thing to realize. Why are you holding bonds? You're holding bonds because they're subject to less risk in terms of price volatility, and they provide this more certain stream of income. So that's the role bonds play. And they should be viewed in that really that idea of bonds being safer assets. Now, you could take risk on the bond side. You could buy higher yielding bonds. But the question is, why are you buying higher yielding bonds? You want more income? You want potentially more price appreciation? Well, you could potentially get it, but you're running the risk of higher volatility and more price fluctuation. So I think those people who want more growth should really look to stocks, because over the long term, stocks have delivered greater price appreciation. And then in terms of income, dividends have been shown over time to really be effective at combating inflation. Now, for those who want to play it safe, bonds, again, do provide less price volatility, but then you're exposing yourself to greater inflation risk. So bonds can play a role in making your portfolio safer, but even if you're age 60 or 70, you could be looking at a few decades in retirement until you still need that growth component in your portfolio, that portion of your portfolio that's going to grow faster than inflation. And from that standpoint, you really need stocks. And even though you might see risk over the short term, it's important to realize that over the long term, stocks have really beaten bonds. And so there's a role that there's really a role that stocks have, even for conservative investors, to have that equity allocation.
Thank you for joining us today, Charles.
Thanks, Kyler. Enjoyed speaking with you.
If you are interested in reading his article, Guidelines for Selecting Bonds and Cash-like Instruments, or others like it, you can find them in the September Journal at aai.com. Once again, thank you, Charles, and have a great day. Hi all. If you weren't aware, we record this show in advance of the broadcast date, and we do like to answer questions in our listener mailbag segment. We didn't receive any questions for this episode of the show in advance, and so I just wanted to remind our viewers and listeners that you can do so. If you have questions for us for a future episode, or on anything you have seen or read from AAII content, please send an email to kwirf@aai.com with the subject line, II Show Question. We will try to get it on air for the next episode. Thank you.
And now a word from our friends at Discover Bank, sponsor of the Individual Investor Show and AAII webinars. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner, Discover Bank, on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Please take a look.
If you liked our show, please visit aai.com/webinars to register for more webinar and video content. Like us on Facebook and follow us on Twitter at AAII_invest_ed. For more investing education, check out our site, aai.com. I want to thank our guests, Roger Young, Matt Bykowski, and Charles Rotblood, and you for listening. See you next time.